Hi, my name is financial coach Ruthie, and my goal is to encourage others to slay debt, gain wealth, and pursue outrageous generosity through intentional living. So today I want to intentionally teach you some basics of investing, and we're going to talk about some things like ETFs and mutual funds and index funds and what active versus passive management looks like. So if you would like to see more videos like this, please hit the subscribe button and watch for more videos. So yes, like I said just now, we're going to cover all of these things. So now, what is active versus passive management? So active management is when you have a portfolio manager who buys and sells stocks for you. And their goal is to outperform or beat the market. And the market is this benchmark of how the market is doing. And usually, because of that, it usually costs more in fees because you are paying somebody to sit there and look at the stock market and read the news and to buy and sell and do the work for you. Versus passive management usually involves buying a fund, usually on your own or through robo-advisor or discount brokerage, and it's usually designed, or the goal of it is just to track the performance of that benchmark. Just follow whatever the benchmark or the economy is doing, and usually that involves less cost and fees because it's usually a buy and hold type of pattern, and the goal is to have long-term growth over the long haul, so years and years, more than 4 or 5 years. So we talked about a little bit of that when we were talking about the banks versus financial advisors and robo-fees, or robo-advisors, I should say, sorry. So we'll have a look at this chart. So there's mutual funds that are the most expensive, which we mentioned that a lot of financial advisors and banks try to sell you. And then there's that group of other financial advisors, the robo-advisors, that usually have a little bit less in fees, the 0.5% in fees for that advice or those recommendations, plus the cost of the ETFs. So those ETFs could cost anywhere 0.1 to 0.3%, so you add that on to that 0.5%. So you're looking at potentially up to 0.8%. So if these percentages and fees mean nothing to you, that's okay, because we're going to get into what that actually looks like. We're going to come back to this page again. So target date funds, those are what I talked about in a previous video. That's what our Alberta Health Services employer matching group funds are invested in through Manulife, is these target date funds. So they you pick how far away you are from retirement, and they do the investing based on that for you. So those are 0.6 to 1.75% in fees. Then there's these all-in-one ETFs, and we'll get to what an ETF is later on, and do-it-yourself ETFs, and then do-it-yourself stocks and bonds, just buying those individually. So what is a mutual fund? So a mutual fund is a collection of investment stocks and bonds and other funds, and it's usually managed by a professional who buys and sells the stocks and bonds in the fund. So you're pooling your money together along with other investors, and you're buying units or shares in that fund. And usually the price is set at the end of the day versus an ETF, which we'll get into more later on, where the price is set and fluctuates throughout the day. Mutual funds are not always guaranteed to make you money. It's a hands-off approach to investing, so you are giving your money to the bank or the financial advisor, and they are doing that investing for you. The con to that is that it can be quite expensive, and 1.5 to 2.5% doesn't sound like a high amount, especially if you're looking at it from the other perspective of a high-interest savings account, but it can be quite expensive. So next is index funds. So those we touched on those a little bit briefly before. So they track the performance of a specific index, and we'll get into what an index is. For example, the S&P/TSX Composite Index is an example of an index that they might track. So the pros to that is that there is a low fee for managing those funds, because they're usually very low maintenance. And it's basically like a set it and forget it. You just keep putting your money into this fund and you just leave it. So you don't have to check the stock market every day. It's a more passive type of investing with built-in diversification. So we'll take the S&P 500 index, for example. So that's the top 500 companies in the US. And so what it does, if there's a company that goes bankrupt or goes under, they're out of that top 500 group and another one comes in. So you have the built-in diversification of 500 different companies and how they're going to do. And if they don't do well, then there's another one that replaces that one. So that's the beauty of that index fund type of investing. So the cons to that is that it requires a lot of work up front to decide and research how to do it, investing yourself instead of paying somebody to do it. So you decide whether you want to do that or not. That's totally up to you. Now, there's a man named Jack Bogle, who is the founder of a company called Vanguard, who were the first ones to start index fund type of investing in 1975. So originally he was laughed at and people were like, oh, you're not going to make any money. This is just like a waste of time. Who's going to follow an index? You want to beat the index, you want to beat the market. You don't want to just like follow it and that's it. But he's still in business today and his company is one of the top companies for investing. So I guess he was wise in the sense of coming up with that. So next are indexes. So what are indexes? There's so many different types of indexes. There's like the NASDAQ, the Dow Jones. We've heard some of those terms before in the news. The S&P, these other ones like the MSCI and the EAFE. Most people probably have not heard of those, but they're just different type of indexes that you can follow. They just track different indexes in general in different companies and in different industries. So again, this S&P TSX Composite one is a Canadian one. So how do you purchase an index? So you can purchase one through mutual funds or through ETFs. You can do it in different industries. You could do it in the technology one, energy one, real estate one. And you can also choose like what type of economy you want to purchase this index in. Do you want it in an emerging market, an international one, a Canadian one, a US one? Do you want to take a US real estate index, for example, and invest your money in that? So that's totally up to you. There's lots of different variations of indexes. Now, what in the world is a closet index? So it's basically pretending to be an index, but charging you more money. So a lot of these mutual funds say they've handpicked all the stocks and all the bonds and the companies that they've invested in, and that's why you are paying high fees is for their expertise. But some of them have really just taken an index, copied it, and pretended that they handpicked these companies. But really, they're charging you more money for the same thing that you could just purchase in an index for less money. So what is an ETF? So an ETF is an exchange traded fund. So it's similar to a mutual fund. It holds a basket of different companies, but they usually tend to follow an index, which makes them cheaper than mutual funds. They trade on the stock exchange like a stock during the daytime, so you can pay different prices for it because the price will fluctuate. So if you go with a discount brokerage, for example, like Questrade or Wealthsimple, you can buy some of these ETFs for free, and then you might pay some money if you're selling them, like for $5 to $10 per ETF that you sell or a share of the ETF. And again, you can buy ETFs in different sectors. You can buy them in the technology, utilities, financials, whatever you want in there. And then there's the option for these all-in-one ETFs, which include bonds and equities together. And I'll talk about that in a couple minutes here. So the cons are that if you wanted to sell them, you would have to pay to sell them. So like we said, it could be $5 to $10 per share. Now, all-in-one ETFs have like a built-in diversification compared to just plain ETFs. So what you could look at is if you wanted to buy something that was 20% bonds and 80% equity, as opposed to 30% bonds, 70% equity, you could go 50-50 or mainly bonds. Now, you might ask yourself, like, what is the point of this? Well, for some people, especially like our target date index, our target date funds with Alberta Health Services, they tend to start with more equity the younger you are when you start investing and work their way up as you get closer to retirement. And like we talked about in the previous video, because bonds are seen as lower risk and more stable, as you get closer to retirement, you usually want that stability more and less of that growth because you're going to be pulling out your money sooner, and you don't have as much time to let it sit and recover any losses that you had. So these all-in-one ETFs offer more diversification, like we talked about, and they have lower fees compared to, say, a mutual fund. So a 0.3% as opposed to a 1.5 to 2.5% fee like a mutual fund. So again, we're going back to these fund of funds or target date funds that we talked about in previous videos. So these usually invest in other funds, and they will do the asset allocation and diversification for you. Like I said, that you just put your money in, it comes off of your paycheck, they match it, and then they invest it for you. So it's pretty low maintenance, but that means that you're going to pay higher fees because you're not doing the work yourself. So we're looking at 1.5%. And again, they're doing what I talked about earlier. They're doing the starting with more equity, and as you get closer to retirement, you're moving up to less equity and more bonds. You can always change this. You're not stuck with this. There are other options that you can explore, but again, it's personal financial information, so it's up to you what you want to do. So what are specialty funds? So they usually focus on special mandates, and some of it is like socially responsible investing. So people who are really passionate about supporting environmental stewardship, human rights, and diversity, and they want to avoid companies that are invested or produce alcohol, tobacco, gambling, weapons, and the military. So those can sound like good things, but the con with that is that they're usually more expensive. And there is the, I guess, the exception that what you consider socially responsible might be different from what I consider socially responsible. So you'd have to really look carefully into those investments and see what they're actually invested in. Now, a T-Rex score. I read this book called Beat the Bank by Larry Bates, and it was an awesome book about Canadian investing. And he came up with this T-Rex score that stands for Total Return Efficiency Index score. And what it is it basically just tells you after a length of time how much of your money you actually get to keep and how much you have to pay in fees. So this is huge because I never heard about this like a year ago or even thought about it. So this is huge in my mind. So he's saying that a T-Rex score above 75% is good, and a true fee below 25% is good. So we're going to have a look at those in a second here. So as we look at this larrybates.ca website, so I want you to have a look at this Larry Bates website, www.larrybates.ca. If you go up to T-Rex score up here in the top corner, it'll give you a list. So we're going to have a look at this today and actually look at what does that mean when we look at fees. So if you had $100,000 and you had a 6% return and you paid 1.75% in fees, like we looked at with our target date funds, and you invested it for 25 years, what would that look like? So you would gain from that $100,000 $329,000, but you would unfortunately have lost $146,000 in fees. You get to keep only $183,000 of that total. So that's not very great. And as you can see along this line, the longer you invest and pay those fees, the more the curve works away from each other, and you get to keep less and less of your money, and more of it goes towards fees, unfortunately. So this T-Rex score here was only 56%, so not great. Whereas if you looked at like one of those all-in-one ETFs at 0.3% here, so look at how much closer that sticks together. They don't deviate away from each other, and you're looking at a T-Rex score of 91%, much better. So you're keeping, you're keeping $299,000, and you're only paying $29,000 in fees. So this is what I mean by saving hundreds of thousands of dollars in fees by just having a lower fee when you're looking at what's the best way to invest your money. So we're going to look back again at this chart. So does this, hopefully looking at this again, it has a little bit more meaning to you and you understand a little bit better what that means by the 1 to 3% fees. So we looked at that 1.75% and it was $146,000 in fees, and that was only after 25 years. So imagine if you started at age 20 and invested for that 40 years, that would look like a lot more in fees. So if you want to pay less in fees, you're going to have to do more of the work yourself. But you're basically paying yourself instead of the bank or those financial advisors. So whose money or whose pocket do you want to put that money into? That's totally up to you. So I'm just going to drive this home a little bit more. Again, we're back to that Get Smarter About Money website, and they have a mutual fund fee calculator. So if you took $1,000 and you invested $100 a month, so $1,200 a year for 40 years, got a 6% return, paid 2.5% in interest fees, you'd end up with $207,000, but you would pay $98,000 in fees and only take home $108,000 in the end of your hard-earned money. Now, if you, same thing, 40 years, 6% interest rate, but you paid 0.7% in fees, you'd only pay $34,000 in fees and keep $172,000 of your own hard-earned money. And again, if we went even lower fees again, if you, same thing, 40 years, 6% interest rate, paid 0.25% in fees, it's only going to cost you $13,000 and you get to keep $193,000. So which one would you choose? Do you want to do the hard work and keep the money, or do you want to just leave it in the hands of somebody else and give them your hard-earned money? Totally up to you. Now I want you to go do some more researching and researching about what type of investments you want to invest in, whether that's index funds or mutual funds. I think you kind of know where I stand with that. But again, it's up to you. It's your own personal finance. It's your own money. Now go and be intentional.